flight to cash underway as investors keep pulling money out of the markets. Last week, $30 billion were yanked from equity mutual funds. That's according to the Investment Company Institute. Well, if you did that, what should you do with all that money right now? Joining us with some ideas is Rob Rusell, president of Rusell Company. He's got 3 smart plays for concerned investors. Good to see you, Rob.
Good to see you, too.
I got a lovely mattress at home. Is that idea number 1?
That is not idea number 1. Number 1 idea would be if you're going to keep a large amount in money market, you want to have a money market that actually has FDIC insurance. Money markets aren't paying a whole lot. FDIC money markets are paying even less, but it's worth having the government backstop on it.
Right.
So
that'll let you sleep at night for sure, right? What are there limits though to that FDIC backing? You can only put in a certain amount, and then maybe you got to open, if you have more than the limit is, you got to open multiple ones.
Yeah, exactly, and it depends on who owns the account, if it's a joint account, if it's a trust account. So you definitely want to look into that and verify what the limits are depending on the ownership rules. Absolutely.
All right, number 2, if you're willing to go up on the risk spectrum, you suggest.
Yeah, so if you're comfortable raising the risk spectrum a little bit, the real value in bonds and fixed incomes is actually overseas. It's not here in the U.S. We're in a 30-year bull run. You're buying at a high. So really, the value is in the emerging markets, in certain international markets, in sovereign debt, sovereign bonds, and corporate bonds, and the yields are substantially higher in the 5-7% range.
I think a lot of people are going to, we keep hearing about a sovereign risk crisis in Europe, and you're suggesting sovereign risk.
Yes.
I mean, doesn't higher yield mean higher risk?
Well, it can be. Also, and I'm not referring to Europe, but more the emerging markets, Asia Pacific, Latin America, places like that. But those places, those countries that have had an inflation issue, they've raised interest rates, pushing bond prices down and increasing yields. So it's a better time to be buying in there, buying more at a low than a high.
Yeah, that makes sense. Ideally, that's what we like to do. In the U.S., senior secured debt. What does that mean and why?
Yeah. Okay, so senior secured debt are loans taken out by some of the biggest companies in the U.S. These are collateralized loans. That means they're more secure than a typical bond. The company has to put up collateral. And the nice thing is they move opposite to interest rates. So with interest rates low, as interest rates rise over time, they actually pay more. It's kind of like an adjustable mortgage, but you're the bank.
All righty, Rob, thank you so much. Joining us from Dayton, Ohio, but the satellite delay felt like he was in Malaysia or something. Good to see you.